Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in corporate filings, and today we're diving into Escalade's latest earnings report. Get ready, because the numbers tell a pretty interesting tale about where this sporting goods company is heading. Escalade, a familiar name in sporting goods, just dropped its quarterly report. Let's see how they're doing. First up, their balance sheet. This is like a snapshot of what the company owns and what it owes. Looking at the end of June this year, Escalade had about $10.4 million in cash. That's up significantly from just $362,000 back in June of last year, which is a good sign for immediate cash needs. Their accounts receivable, which is money customers owe them, stood at about $41.9 million. This is a bit down from the previous year, which could mean they're collecting money from customers a little faster or maybe selling a bit less than before. Now, inventories. This is the stuff they have on hand ready to sell. They had about $72.7 million worth of inventory. This is a good chunk less than the $86.6 million they had last year. Businesses usually like to see their inventory go down, especially if it's selling well, as it means they aren't sitting on products that aren't moving. All their current assets, the stuff they can turn into cash within a year, added up to about $127.9 million. That's down from about $139 million last year. And their total assets, everything they own, came in at around $28.3 million. This is a notable decrease from $243 million a year ago, suggesting they might be selling off some longer term assets or that the value of what they own has decreased. On the other side of the coin, we have liabilities and equity. Their total liabilities are down to about $50 million, significantly lower than the $77 million they reported last year. This is a positive trend, meaning they owe less money. Specifically, their long-term debt has dropped quite a bit from over $36 million last year to about $14.9 million now. This is a great sign of them reducing their borrowing and therefore their interest payments. Stockholders' equity, which is essentially the company's net worth, is around $168.3 million. Now, let's look at how much money they're actually making or losing. This is the operations statement. For the 3 months ending June 30, 2025, their net sales were about $54 million they brought in during the same period last year. Their cost of goods sold also decreased, which is expected when sales go down. Their operating income, which is profit from their main business activities before interest and taxes, came in at $2.6 million. That's down from $4.5 million last year. And their net income, the final profit after all expenses and taxes, was $1.8 million. Last year, for the same quarter, it was $2.8 million. So overall, a bit less profit this quarter compared to last year. This translates to earnings per share of 13 cents for the quarter, down from 21 cents last year. Looking at the first 6 months of the year, sales were $199.8 million last year. Net income for these 6 months was $4.4 million, down from $4.6 million in the prior year. So the trend of lower sales and slightly lower profit seems to be consistent across the first half of the year. This statement shows how the equity section of the balance sheet has changed. We can see how net income, stock issuances, and things like dividends affect the overall ownership value. One thing that jumps out here is a significant purchase of stock, costing $790,000 in the first 6 months of 2025. This means the company is buying back its own shares, which can sometimes be a good sign, as it might indicate management believes the stock is undervalued. Now for the cash flow statement. This is crucial because it tracks the actual cash moving in and out of the business. For the first 6 months of 2025, they generated $17.1 million from their regular business operations. That's a solid increase from $13.3 million in the same period last year. So despite lower sales, their operations are actually bringing in more cash, which is interesting. In investing activities, they spent less on property and equipment this year, about $976,000 compared to $1.2 million last year. This suggests they're being more conservative with capital expenditures. On the financing side, it's a bit mixed. They raised $9 million from issuing debt, but paid back over $12 million in debt. Their dividends paid remained roughly the same. Overall, their cash increased by $6.2 million during the first 6 months of 2025. Let's quickly look at inventories by type. Raw materials inventory saw a bump. Work in progress stayed relatively stable, but finished goods inventory is down about 18% from last year. This reduction in finished goods inventory is a good indicator that they are moving products. This note talks about how they value their financial assets and liabilities. For things like their term loan, they use what's called level 2 inputs to estimate its fair value. Their term loan has a carrying value of $22 million, but its estimated fair value is about $20.7 million. This indicates that due to rising interest rates, the market value of their older debt is less than its book value. Here's something about how they reward their employees and directors with stock. They awarded quite a few restricted stock units and shares in the first half of the year. They recognized about $962,000 in stock-based compensation expense. That's a bit higher than last year, which is normal as more awards vest. They expect to recognize about $2.8 million more in unrecognized stock-based compensation over the next couple of years. This is a cost of doing business, encouraging employees to stay with the company. ESCALADE operates as a single segment, with its chief decision maker looking at the business as a whole. Their sporting goods segment is the primary driver of revenue and profit, with corporate functions having a slight loss. For the 3 months ending June 30, 2025, the sporting goods segment generated all $54.3 million in revenue, with corporate operations having none. The sporting goods segment reported an operating income of $3.2 million, while the corporate segment had an operating loss of $611,000. The vast majority of their assets, about $207.1 million, are tied up in the sporting goods segment. This section breaks down their sales by channel. Sales to mass merchants were $17.3 million for the quarter, down from $19.1 million last year. Sales to specialty dealers also decreased from $21.3 million to $17.6 million. E-commerce sales saw a notable drop from $25.4 million to $22.5 million. Overall net sales for the quarter were $54.3 million, down from $62.5 million in the prior year. The report attributes this to softer market demand and delayed customer shipments due to tariff volatility. They have operating leases for facilities and equipment. Their operating lease costs for the quarter were $525,000, which is down from $901,000 last year. This suggests they've either renegotiated some leases, let some expire, or perhaps consolidated some operations. Looking at future lease payments, they have about $1.6 million in minimum payments remaining, with the bulk of that due in the next 2 years. This is an important update regarding their credit agreement. In October of last year, they amended their credit agreement, which was good news. They got rid of a restrictive covenant related to fixed charge coverage ratios and replaced it with a minimum interest coverage ratio. They also reduced the maximum available credit from $75 million to $60 million, though there's an option to increase it later. They also revised their rules on paying dividends and buying back stock. If their debt to earnings ratio gets too high, they have limits on how much cash they can return to shareholders. As of the end of June, their term loan was $22 million, and they had zero drawn on their revolving credit line. This means they have plenty of borrowing power available if needed. This section is the company's own commentary on their performance. As always, they include a standard disclaimer about forward-looking statements, warning that actual results could be different due to various risks. They state that sales decreased by 13.1% in the second quarter compared to last year. This is mainly due to softer market demand and delayed shipments because of tariffs. Even though they gained some market share in the safety category, it wasn't enough to offset the overall slowdown. Interestingly, their gross margin actually improved, going from 24.2% last year to 24.7% this year. They attribute this to lower fixed costs and reduced inventory handling costs, which helped offset tariff-related expenses and a less favorable product mix. This is a positive sign, showing they're managing costs effectively even to the sales dip. Selling, general and administrative expenses remained relatively flat year over year, which is pretty good considering the sales decline. As a percentage of sales though, SG&A increased because their sales went down. Their effective tax rate increased slightly compared to last year. They reiterate their total debt is about $22 million, a significant drop from $43.2 million last year. Their debt to equity ratio is also much healthier. This is a standard section where management confirms that their internal controls over financial reporting are effective. They state there are no material changes to their risk factors from their last annual report, which means the previously disclosed risks are still relevant. These likely include competition, economic conditions, and supply chain issues. This part details share repurchases. ESCALADE continued its share repurchase program, buying back shares and reducing their outstanding share count. They've bought back over 2.4 million shares since the program began. So what's the overall picture here? It looks like ESCALADE is navigating a challenging market with declining sales, but they're managing their costs well and significantly reducing their debt. The increase in operating cash flow is a strong point indicating good day-to-day business management. Their reduced inventory levels and efforts to control expenses are smart moves in this environment. The increase in their tax rate is something to keep an eye on, but the overall financial health appears to be improving due to debt reduction and better cash generation from operations. Even if top-line sales are a concern, it seems like they are streamlining operations and focusing on efficiency. Reduced inventory levels and efforts to control expenses are smart moves in this environment. The increase in their tax rate is something to keep an eye on, but the overall financial health appears to be improving due to debt reduction and better cash generation from operations, even if top-line sales are a concern. It seems like they are streamlining operations and focusing on efficiency. What do you think about ESCALADE's performance and their strategy to combat declining sales? Leave your thoughts in the comments below. If this deep dive was helpful, please hit that like button and subscribe for more corporate analyses. Also, join our Discord community. It's linked in the description for even more insights and discussions. Thanks for watching. See you next time.